Welcome, everybody. This is Tradonics webinar number 2. Today, we're going to look at market conditions not to trade. This is a very important subject. Every trader has to bring this to the table. A trading system, no matter how good the system is, can only do so much. The fact of the matter is, it is math-based. Now, you have a trading system that has indicators and it plots lines and points and stuff. What it's doing is looking at the math behind the structure, basically. And it can do what it can do based on the math it's looking at, and certain criteria are met. But it cannot see the market the way you and me can see it. So we have to cover that little aspect. Indicators can do what they can do, and then us as traders have to bring our skills to accommodate whatever the indicator can't see. We can see it. And ultimately, as the trader, we're the one that makes the final decision. We're the boss. We are the kings, and we have to make sure that we have the final say. And a lot of times an indicator or a system is going to give you a signal, and you're going to decide not to take it. And that is your right as a trader and your responsibility to do this. So there was a couple of questions that I had looked at. So I started the webinar before I could answer the questions, so I could get the questions in the webinar. Now this is going to be full size, this screen right now. I've just got the slides, but I'm going to do the slideshow so that we have the full screen. Last webinar, it was this size, and some of the charts weren't coming through quite right. So George, that was the question I wanted to get to was, can we go through some time when to trade and not to trade based on certain patterns? Now, there is one, and that's going to be towards the end of this PowerPoint. There is one that we want to look at. Okay. George, I did not know this. Some people are watching this on cell phones. That blew me away, actually. Now, there's no reason why that can't be the case. It just never occurred to me that that was the case. So let's get to this. We're going to start the PowerPoint as a slideshow. We'll go through it. And then if we're still have time left, going to answer some questions. That's my favorite part, is answering the questions. But today, because this is a webinar based on a very specific topic, I'd like to get through the PowerPoint. So we'll go from beginning. Okay, market conditions not to trade. Now, there are good times to trade and there are bad times to trade, and it's important to know the difference. Sometimes the best position you can take is no position at all. Now, often in the FX markets, you're going to find killer setups that will follow through like the dream trades should. Now, other times, there will be nothing that you can trade, and sitting on the sidelines is the best position you can take. Now, this is a decision you will have to make on a day-to-day basis. So knowing what to trade is just as important as knowing what not to trade. Now, if there's one thing I want you to remember, it's this. And now you've heard me say this 100 times, and I've written it in the forum 100 times, and I'm going to keep hundreds of more times. The market will keep doing what it's doing until it stops. Now that sounds like an oversimplification, but this really is the truth. This means that if the market is moving well, it will tend to keep moving well. Now this also means that if the market is moving badly, it will keep moving badly. And this includes when you place a trade. So many times there is a market that is moving very, very badly. It's choppy, it's sideways, it looks horrible. You can't find a trade within what you're looking at. You can see the market on the chart, and there's no discernible trade in there. You can't say, oh yeah, if I took this trade, it would have done well. If I took this trade, it would have done well. You can't even see that. But then a trader will place a trade in that kind of condition, expecting the trade that they're placing to work out when recent behavior of the market has suggested otherwise. So the market is going to keep doing what it's doing until it stops. If it is choppy, you have to assume that it's going to keep being choppy. Now, trading is that one entity where I use the word assume. Now, that's a bad word. You know what they say when you assume? But when it comes to trading, you have to assume a lot. And when the market is moving sideways, when the market is choppy, when it's trending, when the market is moving well, you want to trade based on this. You have to assume that what it's doing is generally going to keep doing this unless you have some reason to think otherwise. All right. So what looks good? What is a good looking market? Now, we always want to put the advantage in our favor, and it's not a bad thing. Like, it's not trickery and it's not cheating if we wait for the nice market conditions before we take a trade. In order to determine what kind of market to stay away from, it's a good idea to know what kind of markets we should be attracted to. So the following is an example of a good market. It moves quite nicely, and you can see there's a definite flow to it. Now, it's not always going to be perfect, but any stumble is quickly smoothed out. Now, this is a nice tradable market. It's got a flow to it. It is not chaotic. It is not bad to look at. You can see there's several trades in it. Those are my charts. Let me turn the volume down. So we've got a picture here of the Euro USD 15-minute chart. And you can see that it has a graceful flow to it. Price moves up and down, and it's fairly consistent. It only has a small amount of chop. No matter how good the market moves, you're going to get these little periods where it pauses and stutters and chops around a little bit and goes sideways. But overall, it's not hard to look at. Overall, you're going to have more winning trades and losing trades. These are the kinds of markets you want to be looking for. So when you get to your seat, you get to your computer, you're looking at the charts. Is this what the market has recently looked like? If it's not, then maybe you want to stay away from it. So this market looks ordered and organized, and it's tradable. This is a picture of a beautiful market. Now, of course, no market will be perfect, but we can see how the market is smooth and quite tradable. Again, this goes back to what I said. It's going to have some stutters and stammers in it, but it's a tradable market. When it moves, it tends to move. So now that we know what a decent market looks like, we're going to take a look at what a bad market looks like. There's going to be several scenarios here. So basically, anything that doesn't look like the previous chart should be cautiously analyzed. Now, there's an element of common sense as to what kind of market should be left alone. If there are no discernible peaks or valleys, if the market is chaotic looking, if there's no rhythm to it, and these are all things that really should be avoided. So what follows is a handful of conditions that you should consider stepping aside for. Alternating colors. Now, this is going to be the first thing that you want to pay attention to. Before I get to that, George said there's no volume. Are we okay? Can you guys hear me all right? Sound is gone. Robin said that. Sean said that. We're back. Okay, I apologize for that. The recorded version will fill in the gaps. Perfect, guys. All right, back to this. Alternating colors. The market is making alternating colored candles, similar in length, one after another. Now below, you're going to see an example of the Euro USD daily chart when there is a period where the market was extremely undecided. Now the candles were printing white, gray, white, gray, white, gray, depending on your charts, green, red, green, red, green, red, and so on. What that means is price is moving up and price is moving down. The price is moving up and price is moving down. And it is forming essentially a range for itself. It has got itself trapped within a high and a low, and it can't make a decision where to go. Now, this is a sense of equilibrium. When this happens, the market, even though it's changing colors quite a lot, it looks fairly erratic. The market is fairly content where it is. There's no big pressure to move either way. When this scenario happens, whatever direction the market is going to move can be fairly unpredictable. We want to stay away from a market that looks like this simply because, A, it is just going to keep doing what it's doing. So if we're taking a trade that is fairly high up in the range, it is going to most likely just pop back down again. If we're taking a trade anywhere within that range, within that structure, we can assume, I'm going to use that word a lot, we can assume that we're getting into a market that is going to continue to do that. We need for that to stop. We have to wait for candles to start printing 2 or 3 or 4 of the same color, going in a direction, making some kind of movement before we are even interested or considering taking a trade. All right. Next one will be railroad tracks. Railroad tracks are a set of 2 candles next to one another. Now, they are longer than average, and they both are different color. The market will shoot up and then come right back down again, or it bolted down only to immediately rebound. Now, after a long move by the market, this can be a reversal signal, but when it appears in a lazy market that's not really moving, the aftermath can be fairly unpredictable. When the market has made a long run, let's say it's gone way up, and then we get these railroad tracks, this can be a reversal pattern. But when the market is doing what we see in the image here, where it's really not going too far in any one direction, we can't make a determination at that point. What's it going to do? Is it going to keep moving up? Is it going to keep coming down? Not only does it mess with the chart, it'll mess with whatever chart patterns that you're going to be looking for, and it messes with the indicators. You're going to get some funny results as per the indicators. If you're looking at the TBL, for example, the long bias may switch back and forth a couple of times. And then in order to ideally take a trade, we need for this to calm down, establish a trend, and then pull back and then resume the trend. So the railroad tracks are going to cause problems. Now, if you're trading off of railroad tracks, you're getting these really big candles, meaning your stop loss is going to be too large, meaning your profit target is going to be too large. There's a lot of uncertainty. There's a lot of unfavorable conditions when you're trying to trade around these. So if they pop up, what I'm looking for is a market to settle down and then continue, pull back, and then give me a trade. Next one is going to be upper and lower wicks. Now, there is a scenario where you will get the market that is very undecided, and it will form many long wicks on both the top and the bottom of the candles. Now, the market repeatedly rallies and drops off very quickly. With the long wicks, you have volume. These are going to be similar to the alternating candles, and often a wiki market, and you're going to hear me refer to it as that, a wiki market, is going to have alternating candles, but these really long upper and lower wicks. With these long upper and lower wicks, we know there's volatility in there. We know that there is market moving, but it's a bit of a battle. We don't know what direction the market wants to move. There is movement. There's a lot of exchange back and forth, but it presents a bit of chaos. And when that happens, it's a tug of war between bulls and the bears, and we're not sure who's going to win this. So trying to trade inside of that kind of condition is very, very risky. Some of these wicks are going to spike. They're going to be very long, and they're going to take you potentially out of a trade. They may shoot in your favor, but they may not. And that's not a risk that I'm really willing to take when it comes to my trading account. When I get a spiky market like this, I am just going to let it go until it starts to settle down. Outside of the square, on the right-hand side, you can see the market starts to settle. The candle bodies become bigger in comparison to the wicks. You don't get so much wickiness. And then at that point, I'm just looking for, again, the trend, the pullback, and then the trade. But this condition has to settle down first. Sawtooth. Now, we've got some funky names for some of these, but essentially when you see them, you're going to say, yeah, I shouldn't be trading this. Now, the sawtooth is a market condition where a price displaying a variety of candle types. Now, we're going to see all kinds. Now, it could be moving up or down overall. So it'll have a general downward direction, might have a general upward direction, or it just might have a general sideways direction. But in doing this, in making this movement, it's going to chop around quite a lot. A sawtoothing market is kind of like the junk drawer of candle formations. It's very difficult to trade and will likely stop you out before you hit your target. Now, we mentioned that it can move in a direction. Now, we can have a down trend and it can be moving downwards overall. But the up and the down and the up and the down that it does is going to move further than stop losses are placed. It's going to be spiky. You're going to have quick moves up, quick moves down. There's not going to be that nice flow to it. If you are getting into a trade, you have to assume that in a market like this, that it is going to go against you almost immediately, that you're going to get into the trade and it might move in your favor, but then as per what it's been doing, it is going to reverse, spike against you, and then maybe come back in your direction again. If you're taking a trade in this kind of market, in a sawtoothing market, you have to expect the trade to go against you. I do not want to take trades that are going to go against me. So this is a kind of a condition that I'm going to leave alone. Sideways. Now, a lot of traders are getting hammered by this one. A sideways market is just that. Price is moving sideways and making very small, undefined candles. Now, when price is in these little ranges, the indicators are forced to interpret the market in some way so that we end up getting a lot of fake signals that mean absolutely nothing. When you have a sideways market, the indicators are still reading where the candles are closing compared to where the candles have closed and so on. And we're going to get signals. We're going to get signals to go long. We're going to get signals to go short. Now, depending on what direction the market was moving prior to the sideways market, the trend is generally going to be in that direction. So if the market, in this example, moved up before it got to the red square, if the market's moved up and then starts going sideways, the trend is going to basically still be up. Nothing major has changed the trend, but the trend is going to appear to be up. But in a sideways market, the up movement just isn't going to happen. It's going to make these little moves up, then it's going to correct. It's going to make a little more moves up. It's going to correct. It's going to come back. And it's just going to move sideways. This is a scenario that we get after generally there's two reasons we would get this. First is the market has made a significant move and needs that period to pause. Second is generally the time of day that we're trading. Now, if we're trading a 15-minute, and I want to cover this, but if we're trading a smaller time frame, 15-minute, 5-minute, we're going to find after London closes throughout New York, maybe into Asia, when there's just not a lot of volume, when there's just not a lot of currencies exchanging hands, that the market's going to move sideways. So if you are in a market that's moving sideways, you can kind of see what the range is. You know, if no candle has moved much further than 10 or 15 pips, placing a trade in that environment, expecting a 30 pip target to get hit is unlikely. It's not going to happen. You don't want to be placing a trade expecting more out of the market than the market has been delivering. It can't go above and beyond what it's already doing simply because you're going to place a trade and expect the market to move as a result. There we go. Shark tooth. This will make sense when you see it on the chart. Now, the market makes very quick and sharp highs and lows. Now, the flow is very erratic, and the highs and lows are quite close together. Even though the price does move quite a distance, the market hasn't chosen an overall direction to move in. And we find this as well. Like a lot of the members in the forum are taking trades in a toothy environment like this. It looks like shark teeth, and it makes these very peaky highs and very pointy lows. And it just bang, 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 back and forth. It gets kind of stuck in a sideways market, but it does move. It prints 3 or 4 candles in a direction and then changes all on a dime. 3 or 4 or 5 candles in another direction, and then changes 3, 4, 5, 6 candles in the opposite direction. And it gets stuck there. But because it's bigger, we may get trading opportunities because it's not quite like a sawtooth where we have just a very chaotic and quick mishmash. There's a little more orientation. There's a little bit more flow to this. When the market moves up, it's moving up. When it moves down, it's moving down. But it gets stuck and it changes direction. When it does change direction, it can change direction very, very quickly and just make a beeline to the opposite side. Again, this becomes a scenario. If you can identify this, if you're opened your charts and you see that very recently, this is the condition you'd be trading in. This is what the market's been doing. You have to assume that the trade you take is going to be exposed to more of this. So if I'm expecting the market to go beyond whatever the highs and lows of this shark tooth range is, the probabilities are very low. I want to make sure that it gets out of this. I want to make sure that it has stopped doing it by printing different size candles, by getting out of the range ideally. So you've got a high. See, we have a high across the tops. You've got a low across the bottoms. Now they're not all exactly the same, but you get a general idea of where that highs and lows are. I want to see price breaking above. I want to see price getting below and then sort of stopping what's currently happening. Once we get out of that range and then I get the trend, I get the pullback, I'm happy to take a trade. Long entry candles. A lot of traders fall prey to this one. The market only has so much potential to move, so many pips. And if your entry candle is larger than average, it will have used up a good deal of the potential move in that one candle. Now, if that doesn't make any sense, there's a couple of pages where I cover this a little bit, but I'll show it to you here. From this low, I don't know if you can see my cursor. On the left side of the chart, we've got this string of white candles that go up from the low to the high. We're going to say we're looking at 100 pip range. From the high to the low, maybe there's 110 pips. From the low to this high, maybe that's closer to 70 pips. You know, from this low to this high, maybe that's closer to 100 pips. And again, we're looking at 110. You get an idea for how the market moves. It makes these swings up and down and up and down. So I've got 100 pips, maybe average. If my entry candle is something like 70 pips, 80 pips, I have to assume that most of that market movement has been used up in that candle. All right, I'm going to get to the next couple slides, but I think I'll be coming back to this one. So my rule of thumb is if the entry candle is 2.5 times larger than the candles that came before it, I'm going to miss the trade. The market moves in waves, and these waves are fairly consistent in how many pips they move. For example, the waves of the market movement are approximately 100 pips. You don't want to enter on a candle that is 70 pips long, as it is used almost the entire wave potential in one candle. The stop loss has to be so much larger, and going for a 1-to-1 target, the take profit will also have to be very large. You'll be asking more from the market than it can deliver. I have another one. All right. So I'm going to go back to this chart. If we were going to take this trade, the entry would be at the close of this candle. It's a conservative short. We have a signal for it. So we're going to be entering at the close of this really big candle, which means our stop loss has to go above the TBM or the TBS, TBM ideally, but that is still a monster stop loss. So if I'm going to place a stop loss that is 65 pips away from where I'm entering, to get 1-to-1, just to get a 1-to-1 out of that, the take profit has to be 65 pips way down here. Now, there's nothing in recent history that has made me believe that the market can move that far in one go. I'm asking an awful lot out of this market that is showing me it hasn't been able to do that. So if I'm taking a trade on this really long candle, I'm expecting more than it can deliver. And as a result, it's not going to be able to deliver. First of all, it doesn't know that you're asking for it to deliver, so it's not trying to. So it's going to make its correction, and it might not even get out of the gate. You're going to place the trade, and immediately it's going to go against you while it makes its correction. And this is a very good example of that. All right. The big initial move. Now, this is one that we've come across, I think, consistently in the Tradonics forum. Price will often want to take a break after a lengthy move. Now, this can result in a choppy market as it rests. During this time, it can move sideways, or it can even look like it wants to attempt to move again, but it fails. It doesn't. It'll try. It looks like it's setting up for it, and then it just doesn't have the steam to do it. And this is a nice example of this. The trend changes direction, and as we get that change in direction, now this doesn't always happen this way, but when occasionally the trend changes direction, it's got some potential to it, and it will move. It'll take this really bigger than average move. So we'll see that the price around it, market's not moving that far. You get a change in direction. It moves really, really well. We're looking for the pullback. We get that in here. And then whatever trades we take after that pullback can result in either small trades, small losses, and at times the full loss. And I think a lot of traders in the forum these days, right now, are experiencing some of this. So when we get this really big move, the trades that follow it are unproductive. All right. The market needs its recovery time, and this will be a long sideways pause or a healthy temporary reversal. Now, if we don't get that, the next push can be very short-lived, resulting in a lost trade. I always use the analogy of an athlete. Somebody doing stairs, for example. If you're running as hard as you can up a set of stairs and you don't get the break at the top of the stairs that you need, doing that set of stairs again is virtually impossible. You can maybe start, but you won't be able to go very far. You need the break. You need that pause in order to regain the momentum. So this is another example of what the market does after a big move. Now, the long trade that was signaled after the big move would have been the loser. And the long trade is at the beginning of the square, right in here. So we would have seen the market make this very big move. Now, this is in a trend. The trend didn't even change direction. So what we can see previously, the market isn't making substantially huge moves, but we do get one. We get this big move in one direction, and then we get a pullback. And it wasn't very long. This pullback happened, and then it just paused. It needed this pause in here in order to regain its momentum. So what's in the red square is essentially the pause that the market needed after that big initial move. A lot of traders are getting faked out by this. So the pullback was only a few candles after the big move. Now, this one was only 3 or 4 candles before we got a signal to go long or short again. And this generally isn't enough recovery time. I like to see around 10 candles to properly recover. This question has come up a few times, so I'm making sure that we're addressing this. In the first image, we get the move down. We get 1, 2, 3, 4, about 4 or 5 candles before we get our next signal to go short. And that's not usually enough time. Again, 1, 2, 3, 4, 5 candles before we get a signal to go long. So we have a very aggressive move, a very fast pullback, and then a trigger again in the trend direction. Of course, there's going to be times where this does work. Nothing in Forex is 100%. So we want to take a look at the probabilities. When we get a pullback that is very fast and then the trigger happens very quickly, the probabilities are that the market will try to move, but can't. So we are going to want a little bit more of a recovery time. Now, this is a better example. So we've got an example of a pause in the market that allowed the market to resume its move. Now, it was a pullback over several candles instead of only 3 or 4 or 5. Now, a 10 candle pullback is a nice number. The more, the better. If you can get 12, 15 candles as the pullback or the pause happens, the more candles that I get before I get a signal, the more and more interested I'm actually in taking the trade. If I get the pullback and then very, very quickly I get a signal, I'm not interested in that one. We get a signal to go short right here, just before the blue arrow. This is a conservative short, and this one didn't work. It happened 1, 2, 3, 4, 5, 6, about 6 candles after the move down. This one is starting to stretch itself out, and it had some potential, but then we 5, 6, 7, 8, 9, 10. So another 10, 11, 12 candles later, we did get a move. It rested enough to regain its momentum. So the trade that we took at this point took off. So if you want a number as far as candles go, I would go with 10 or more. If I have 10 candles where the market has paused, 10 candles where it was able to rest, 10 candles to regain its momentum, candle number 10, 11, 12, and so on, has a much better opportunity, has a much better potential for moving back with the trend again. Now, Cliff mentions here that these are easy to see in hindsight, and everything in trading is easy to see in hindsight. It's easy to see the setups. It's easy to see how the market moves. This is something you need to practice. You have to be aware, first of all, of what it is you're looking at. Be aware of these scenarios, aware of the situations, aware that we're looking at a sideways market. If it's range bound, if we have some chop, some chaos. Again, I'm always going to come back to that saying, the market's going to continue to do what it has been doing until it stops. So if I'm getting into a market, look at the chart right now. This chart that we have on the PowerPoint slide is sideways, and it made one tiny attempt, drop down, but it popped right back up again. Do I want to take a trade in the market that looks like this? I do not, because I have to assume that it's going to keep going sideways, that it's going to keep delivering what it's been delivering. There's no reason for it to change just now, so I am not going to be wanting to take a trade in this. This is an environment that I have to assume too much from the market. I have to ask the market to do something that it's not doing. So for me to take a trade and expecting the price to, well, it's a sell trade, so expecting the price to give me 20 pips when its range is maybe 5 or 6 or 10 pips is unrealistic. I need to see that there is a move. I need to see, again, that the pullback happens and then that we get that continuation. In this condition, the market is just not delivering. So I'm not going to be trying to trade that. All right. The time of day. This was one I added last night, kind of in the wee hours. We've talked about the conditions. This is what I need to see, and this is what I don't want to see, and this, if I see this, I'm going to leave that alone. But this is a big deal. This time of day trips up a lot of people. Even when the market is moving well. Now, there are certain periods of the trading day that should be avoided. Although the Forex markets are open for business around the clock, not all times of day make good times to trade. This will apply more to the smaller time frames, to the 5 and 15-minute charts. Now, if you're trading the 1 hour, the 4 hour, or the daily, these off periods will be absorbed by the size of the candles. Now, the 4 hour in the daily, you won't even notice the slow times. The 1 hour will present you with a few smaller candles that at the end of the day won't really affect the trade that you may be in. You'll just be presented with these little candles. On our charts, we have an indicator called the market hours indicator. Now, when it's set up properly, it will show us the different sessions that occur and at what times. Now, there are 3 main sessions. We've got the Tokyo or the Asian session. We've got the London, which is sometimes called the European session. That'll work because it's 1 hour shifted off, but we've got the London, and then we've got the New York or the US session. Tokyo, London, New York. Now, they're named, the cities are named because those are the financial centers of those areas. All right. On our indicator, we've got 2 more sessions. We've got the Frankfurt session. Now, this is the actual European session. And we have the Sydney session or the Australian session. So on the indicator itself, Sydney is the dark red, Tokyo is the red, Frankfurt is the dark blue, London is the light blue, and New York is the green. Now, as the indicator goes, I know some traders will actually remove or color black or color none some of the different sessions. So all they have is London and New York. You can do this however you like. You can change the indicator settings to what you need to, delete certain sessions, only have them present, change the colors, and so on. Now, each session has business hours that go from 8 a.m. to 5 p.m. Every currency has a home session. So the euro has the London session, the pound has the London session, the Australian dollar, the New Zealand dollar both have the Tokyo session. The US dollar, the Canadian dollar have the New York session. Japanese yen, again with the Tokyo session. So each currency will move best during its own session or during its country's hours of business. Currency pairs are built of two currencies. So we'll see some pairs move over a longer period of time. For example, the Euro USD will move well during both the London session and the New York session. The pound yen will be active during the Tokyo session and the London session. These are the sessions where those particular currencies are being traded. When you've got the euro, it is being traded aggressively during the London session because that is Europe's business hours. It's doing business. It is buying and selling. And the same thing goes for New York. You've got the US dollar. It is going to be moving during the US hours of business because that is when those companies, those people, those entities are doing business. So on the other hand, there are pairs that have currencies that are most active during the same session. So you've got the Australian dollar, Japanese yen. Often we'll find quite active in only the Tokyo session. The euro pound will be active in the London session. The US dollar, Canadian dollar will be quite active in the New York session. Now, pairs that get outside of their sessions will move, but they will move slower and with less momentum. Now, this is a good point of reference as far as when you see a market moving slow. If the market is moving slowly, why is that? And a lot of times you're going to find it's out of session. Now, this isn't always going to be the case. You'll find with the Australian dollar, Japanese yen, for example, it can move really, really well in the London session, even though neither of those pairs are active. You've just got other pairs doing other things, which is going to influence sort of by default the value of either the Japanese yen, the Australian dollar. So you will find that certain currencies will move well outside of their sessions at times. So this is not hard written in stone, but if you are seeing that you've got several pairs to choose from, what session is it most likely going to be active in? The US session is an interesting session, and it's important that you become aware of this aspect of it. This is huge. The New York session is quite active during its first half while it overlaps London. Now, once London closes, the US dollar currency pairs will get slow and start to move sideways. And this is virtually all of the currency pairs will get slow and start to move sideways. While London and New York are overlapped, as in the chart, we get some nice movement. Often, currency pairs will change direction during the first hour of the New York session open. That's an important note as well. When New York is all by itself, there is no other players. Now, do I have a slide that covers that? Okay. I just wanted to know what I could explain. When New York is open, all by itself at the end, the last half of New York, we can see by the chart, we've got Sydney, we've got Tokyo, we've got Frankfurt, we've got London, we've got New York. You have a series of overlap. Businesses, different countries are doing business with each other. You've got London and you've got New York. They're doing exchanges, and that makes the market move. All right, so you've got all of this back and forth, which changes the exchange rate. So you've got these currency exchanges, and that's what we're trading, is the change of these currencies. Now, when London closes, the last man standing, as it were, is New York. It's all by itself. And at that point, who does New York trade with? Nobody. They can't trade with anybody because it's all done. All of the other sessions are sleeping, and there's just no There is no exchange that is going to happen. So that last half of New York is often going to be very, very quiet. Again, not 100%. Sometimes the market moves in that last half of New York, but most of the time it gets very quiet. This is a chart of the Euro USD. Now, the London session moves quite dramatically compared to the slow markets outside of London. This is before and after that box. The market is slow during the second half of the New York session. Now, it's important to note that this is the Euro USD. The USD part of this should mean that, I'm making little quotation marks with my fingers, should mean that even though there's the US dollar in it, it should move nice during the US session. But as I've explained, once London closes, there is nobody for US to exchange currencies with. The Asian markets are closed. The European markets are closed. There is no order of business. All of that business that happened in North America, for example, Canada, Mexico, States, they've all taken care of their business the first couple of hours during the session. And then that's done. It's taken care of. And then what happens afterwards is just a fall off. We get this very slow, just non-directional, very low momentum, very low volume trickle out the side. So taking a trade when the market experiences this low volume phase becomes higher risk because it doesn't have the momentum to keep the trend alive. It doesn't have the momentum to keep pushing in that direction. We'll get the pullbacks. We'll get these little movements. We'll get stutters. We'll get small moves. We're not going to be hitting any home runs when we are taking a trade in this kind of environment. It's very good, important. It's important to know that this is the case with the US session. I've pointed it out so many times in the forum. I'm going to keep doing that too. If there's a session that has made the market dead, then we want to address that. And this one is the most common one. So we have the end of the New York session, and often throughout the first half or most of Asia, we're going to find that the market can be very, very slow. London, almost everything moves well in London because you've got all of Europe, you've got London, you've got early New York, you've got late Asia. You've got businesses aren't restricted entirely to that 8 to 5 window. The bigger the business, the earlier they'll start, the later they will go. So what you'll have is a little bit bigger overlap. So you get London is just the sweet spot. If you're going to trade and you can choose a period of time that you can, like if you can choose a period of time that works best for you, if you have the ability to choose that period, then the London session would be the ideal session because you have the entire world virtually trading at the same time. You've got so much currency exchange happening that the market not only moves, but it can move far. And it has a better sense of predictability because there's so much momentum that pushes the market. All right, the end. There's other things that we should consider too. And we didn't cover that in this webinar, but we have range-bound markets. Now that's going to be presented in the next webinar. But when we have a market that is range-bound, we'll see that we have highs and lows. And until we get out of those highs and lows, then the market's going to get trapped. So let's just get rid of this, pull up a chart. So, all right, I am looking at this is a 5-minute pound Japanese yen. All right. What do I see right now? So I'm taking a look at what I see. It's too dark. Let's lighten that up a bit. I want to lighten it up, but I don't want to hide the candles that are behind it. Does that work? Yeesh. Oh, let's just get rid of that. We've got this section, here, let's do this. This might work better. A vertical line, make it a solid, make it a little bit thicker so that we can see it on our smartphones. And then this is what I'm looking at right now. Now, this is current. This is exactly right here, right now. We're looking at the 5-minute pound Japanese yen. What we're looking at is a market that is very, very flat. Do I want to take a trade in a market that is very, very flat? I do not. Even if I get a signal to do so, I am not going to be that keen on taking this kind of trade because I have to assume that the market is going to keep doing this. It is going to give me a signal. It's going to pop up. But most likely what's going to happen is this sideways movement is going to continue. So I've got that. I've got the market that I'm looking at not being something that looks like is going to give me very much on this particular trade. If I were to take this trade, I could expect the market to move the way it's been moving. The second thing is I'm taking a look at the session. I've got the close of London right here, which means from here to here is the last half of the New York session. And as we just discussed, the last half of the New York session can be often very quiet. So we've got pound yen, right? In the Asian session, the market popped a little bit. In the London session, the market moved quite a bit. Actually, this was the Brexit. I don't even want to mention it, but it looks like it's part of the chart movement. Brexit is fundamentally driven right now. There's a lot of reaction to what is going on as far as vote tallies go. So it's fundamentally driven, but you'd never know that by looking at the charts. Now, we can take a look at this scenario right here. This is even though this is fundamentally driven, we have all of the aspects that we had looked at still in play here. We had this big move. We had the big initial move. Great big move up. 1, 2, 3, 4, 5. We had 5 candle pullback, and then we got a trigger to go long. And the market didn't move very far. So if we have the trigger to go long, with a stop of 89 pips. The most we would have got out of this one was 58. We would have reduced our stop loss by maybe 30-ish pips. So we wouldn't have taken the full loss, but we wouldn't have won this trade. It would have been a losing trade. Big initial move, very quick pullback, and a resumption in the trend direction. And this resulted in a poor trade. It just did not go very far. It's a 15-minute time frame. So there is issues with the sound. So some of you are not getting the sound all the time. I wonder if that is me or if that's the software. When I discuss these topics, and I've gotten some flack for it, I tend to repeat myself quite a bit. And the reason I do that is to hammer points home. I want to make sure that what I said doesn't get overlooked. So I will repeat the same thing in 3 or 4 different ways. I try to say this, and then I'll say it this way, and then I'll say it that way, and then I'll say it some other way, just so that it gets across. Because I don't want you to spend your time here and then miss something that I'm trying to present to you. So I'll say it over and over, and if you have questions, you ask me over and over, and I will present it to you in different ways over and over until, which is the key word, until we get it, until you get it, until I can get the point across. I'm going to take a look at this period of time. The pound Japanese yen. This is a market that is very sideways. So if I'm getting into this market kind of at this point, I'm taking a look at what the market has been doing. It has not delivered very much. This is the pound yen. This is in the Asian session. It should be moving. It should have some legs to it. It should. But when it comes to Forex, nothing is 100%. It should have some legs to this thing, and it doesn't. So because it's the Asian session, it should be moving, but it isn't moving. So I'm not going to trade it. I'm going to wait for something else. Sometimes, and I'd hate for an individual to trade based on this, but the open of a new session can inspire new life in a flat market. So we have the open of London, and we did get a bit of a spike. The London opened, and then the market changed direction, and then it went on its way. It moved quite nice during the London session. So the session is a good thing to keep in mind. You want to keep in mind what the currency pair is and what session it's in. And often it's going to move well during those sessions. But again, 100%, never anything is 100%. You're going to get markets that should move well in Asia that it moved better in London for some reason, or it moved better in New York for some reason. But the probabilities are that when you've got a pair within its session, it has the most potential to move. Right? I think I saw something wiki. Okay, there's a nice example of a market I don't want to touch. This would be kind of your sawtooth. You've got a variety of candles ranging from little tiny candles, great big long ones, no real direction. You've got a mixture of sawtooth and shark tooth going on in here. You've just got a mess. You've got two identical gray candles in here too. Like, you have just chaos, and it is risky taking a trade in an environment that looks like this. I don't want to do that. There's enough currency pairs that if the market looks the way it looks, find one that does. Find one that does. That makes no sense. What I'm doing is reading comments and trying to talk at the same time. And multitasking is not a thing that I am accomplished at. So what's going to happen is you find a market that looks like this. I'm going to not trade it, first of all. I'm probably not going to spend any time on it at all. So I come across the US dollar Swiss franc, which is what this is, during my window. I've got a couple hours. I'm going to sit down and trade. This is what the market looks like. I can scratch this one off my list for today. I'm not interested in this one. I do not want to trade this. It's going to be high risk, low probability, just mess. Targets they have to be small. Stop losses have to be wide. Like, just nothing about this makes for a promising looking trade. This becomes off my watch list. I'm going to just not even bother with this until tomorrow. Markets are going to change from day to day. Today, this market looks awful. It looks horrible. Tomorrow, I'm going to check back. I'm going to check it out, and it could be 100% better. It could be the perfect market. Tomorrow, this could be exactly the market that I want to trade. Today, it's not. So I'm not going to waste my time with it. I've got so many different currency pairs. I don't have a ton of them, but I've got enough that I can find something in those currency pairs. Now, this is an important thing for me anyways. If I am looking through my different currency pairs and I am not finding something that I like, I'm not going to trade. If I can look through all my pairs and just find nothing, the garbage, the market is garbage. It's just yucky, it's just not tradable. And all my pairs are doing that, then I'm done trading for the day. I am not going to trade. I'm not going to open up new currency pairs. I'm not going to be looking on different time frames. I'm not going to be hunting for something to trade just so that I can trade. I'm going to be looking for the pairs that I've grown to understand. I'm going to be looking at the pairs that I've come to know and have personality types. I know when certain pairs should be moving. I know when they are most likely to be active. And then from there, I'm going to stick to them. I want to develop a relationship with my currency pairs. I know them and I know what they're likely to do. If I start digging around in currency pairs that I don't trade, the subtle differences might throw me off. It's not worth the risk. David, that's exactly how that works. Consolidation leads to expansion, which leads to consolidation, and so on. That's a cycle. But trying to time that cycle is generally very difficult. You've got a consolidated pair. Right now, this was the sideways market leading up to the open of Frankfurt. This was Brexit. All right, so you've got this sideways consolidation. Yes, when you have a consolidated market and it is going sideways and it's flat, it's going to start moving at some point. It's not going to stay that way. But trying to time that, if there is no valid reason to time this, if you are not looking for the open of a session, if you're not looking for a fundamental report like a news report or something to come out, if there's just no real good reason to expect that the market is going to move, you have to assume that that cycle is going to stay in that phase until it changes. And then I need it to change first, show me that it's changed, prove that it's changed, and then I can trade it. And the same thing goes with a trend. If we get this nice big move up, at this point, it has shown me that it's changed. It had this huge move up, 1, 2, 3, 4, 5 candles down, started to move up. I'm familiar with this now. I know that after a big move, if I don't get the resting period that I need out of this, that the market is going to try to go. It is going to try to move, but it won't be that successful. The trade that I take is going to be high risk, low probability. I might get a little bit out of it, but it's more than likely not going to hit my take profit. And my stop loss will get hit. It'll be a reduced loss. But if I can avoid the loss altogether, then that's what I want to do. How do we know that the market has left the consolidation? So what we're going to look at, let's find, again, cherry picking. I'm going to find one consolidated market that we can really nicely take a look at. The news going on, it is what we're looking at, yeah. As soon as you're looking for something, it disappears. Oh, let's go to a 15-minute time frame. I like the 15-minute because it encompasses a lot of time in a nice digestible period. What you're going to find is consolidation generally remains within a high and a low. It will generally stay inside of that range. It's not going to move too far beyond it. What I need for this to be over is, first of all, for the price to get out of that range. So I'm looking for price to move out of it. And then I'm looking for the pullback to happen. And then I'm looking for that movement to continue. But the big deal with a range, with a consolidated market, is that it gets out of the consolidation. That it gets out of its highs or gets below its lows and then starts to move. When you're looking at consolidation on a higher time frame, you get generally a clearer picture. When you're looking at it on the time frame you're trading, sometimes it gets a little blurry. We want to take a look at what the biggest potential is. It is going to be, for lack of a better word, well, that's what it is a breakout. You're going to have a breakout of the consolidation, but we don't often trade the breakout because we need a trend. Now, if I get a breakout on a higher time frame, say this is a 15-minute time frame, and then I go back to the 5-minute, I've got the breakout in here. I'll be looking for the pullback. We don't get this. Again, this is news. This is the Brexit thing, but we're going to get the pullback maybe in this area. We're going to get the pullback shortly after the breakout, and the pullback will generally want to come to the top of this box and then take off. So at that point, we've got what it's been doing changing. It's not in the range anymore. The consolidation has stopped. Generally, it's going to start printing candles that are 2, 3, 4 in a row of the same color. The candle bodies, they're going to be a little bit bigger than what they were while they were in the range. Just the features of the candles are going to start looking different. We're not going to have so many wicks. If you're looking at a wiki market, the wicks are going to start disappearing. You're going to get bigger bodies and smaller wicks. So whatever it is we're looking at, you've got the alternating colors, gray, white, gray, white. You're going to start getting 2 or 3 grays, 4 grays, 5 whites. You're going to start getting whatever the condition is, different. Alternating candles will no longer be alternating candles. Wicky markets will be more solid. You'll have bigger bodies, less wicks, and so on. Like the conditions that you're trying to avoid are going to start changing. If it's range bound, you want to get out of the range. If it's consolidated and flat, then you want to start seeing bigger candles printed. You want to see it moved outside of the range and so on. When the market goes above or below the trend lines, would this be a good place to trade? It can be indeed. I'd like for it to follow the rules of the system though. Next week, we're going to look at exactly that. Support resistance. We're going to look at these breakouts. We're going to look at exactly what we're looking at here. Support resistance levels and trend lines. And then from there, when you get breaks of support and resistance levels, when you get breaks of trend lines, then you have market conditions that are starting to change. And they are something that you can take advantage of. When you get a market condition that changes because of something you don't like, support resistance levels and trend lines do become really key features of the end. This is one of the great tools that can get you into a trade as the reason for not trading ends. Let me rephrase that. You're avoiding a certain type of market because of the way it's acting. You want to get into it once it changes, but often you need some considerable movement. The price has got to change. It's got to pull back. It's got to give us sort of the play-by-play. Now, if we're using trend lines, if we're using support and resistance, we're going to be able to get in on that without all that extra confirmation if you're using these tools right. That is the subject of next week's webinar. We're going to talk about that at length. Okay, so how do I count the number of candles? Well, I can count them. Let's find this. This one was a nice one. 1, 2, 3, 4, 5, 6, and then we've got one that pulls back. So I can count them this way, or I can use my crosshairs, and then on the one candle, drag over. You can see the number right next to the crosshair is how many candles over I go. Right now, this is 6, 5, 4, 15, 16, 17, 18. So I can count the candles that way. If I get less than 10, it makes for me a trade that I am not comfortable with. If you get the big market movement, I would love to see at least 10 candles occur before I get the resumption of the trend. All right, I want the trend to resume, but I need the pause. I need the rest before that resumption happens. Otherwise, it's taking off without having rebuilt its momentum, and it's just not going to go anywhere. Adrian is answering questions in the background. Thank you so much for that, Adrian. Again, this is one that I'd like to do, and today I was going to, until I realized that my boy is out of school in not too long. It's 10 after the hour, and the farthest that I can take this is 15 after the hour. And then I've got to go. Yeah. Shiva, you mentioned, that's about 2 to 2.5 hours on a 15-minute chart. That would be right. Yep. So 2 hours, you're looking at 8 candles. 2.5 hours, you're looking at 10. So between 2 and 3 hours after we get this big move, then I'd be willing to come back and reassess the charts. No after party today, and I had plans to get my recorder going and everything. The TA. This is the webinar that I wanted to get out of the way. So the TA, I discussed it with the back end before we started the webinar. So after this webinar, we're going to start getting it up. The TA is ready to go, but I want, they're going to upload it. There'll be a link provided. You're going to get an email for this, and it should be within the next few hours. Now, I'm going to say a little bit more than that, because this is kind of a funny time of day. For me, it's okay. But for a lot of the people that are working behind the scenes, this is the very, very end of their day. And like some of you, some of the guys that are in the back end on the webinar, making sure that things don't go down, whatever the case is, fixing audio problems if they can. It's very late for them, just like it is for some of you, 2 o'clock, 3 o'clock, 4 o'clock in the morning. So I'm not going to push them on this one, but as soon as they get up, as soon as the right people are working, we're going to have that TA uploaded. I wanted this, though, to be presented to you so that you had an idea of what not to trade. The TA, because I know this is what's going to happen, because this happens every time. There's going to be traders that will put the TA up on every single currency pair that they have. It'll be a small time frame, like the 5-minute, and they are going to take every single trade that pops up with it. Doesn't matter the conditions. It doesn't matter the time of day. It doesn't matter how big or small the stop loss is. If the alert pops up, they are going to take the trade. And this isn't generally going to work out very well. You have to have an aspect of responsibility when it comes to this. And with this particular webinar, hopefully that presents some scenarios. Now, there was a lot that was covered here. I mean, we covered a lot. So I don't expect you to know everything that we did. What it comes down to, though, is that one saying. I say it over and over and over again. This one right there. The market will keep doing what it's doing until it stops. Now, if you are looking at a chart and it is doing something that you wouldn't have traded if you knew it was looking like that, you look back at it, you say, yeah, that's a horrible mess. There was no trades in there that would have won. If I had taken any trade in this area, I would have lost. That's easy to see in hindsight, like was mentioned. You can see this in hindsight. Oh yeah, no, I wouldn't trade that because it looks terrible. If that's the condition you're getting into, I mean, this is my right side of the chart. If this is the condition I'm looking at, all these trades that don't work, I get signals for trades and they don't work. Market is flat. It's choppy. It's found a bottom. Like there's a bottom right here. Boom, 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 boom. Like it's not able to get below this. These trades aren't working. There's no flow to it. It doesn't look nice at all. Like if this is a situation that you're coming across, you have to assume that if you're going to take a trade, that the market's going to keep doing that. You're going to be in this now. You're going to be inside a trade of a market you don't want to be in. There's a saying is, I'd rather be out of a trade wishing I was in than in a trade wishing I was out. And seeing that the market is moving badly, but then taking a trade puts you in a bad situation that you don't want to be in. Some traders can't resist the signal. The signal pops up, they have to take it. There's a pit bull. They jump all over that. They've got to take that signal because it might work out. With the TA, that's going to be even worse because an alert will pop up on your computer screen and you don't even have to look at the chart. And that's my fear. So getting this webinar out of the way, understanding that the market can be yucky. There's going to be times where it's not nice. There's going to be times where it's chaotic. There's going to be times where it's slow. It's smooth, but very, very sideways and quiet and calm, but not moving. There's going to be times where you have all of this. Like when I was testing the TA, I would get these signals that popped up and I'd see, oh, it was the Australian dollar, US dollar. Well, I haven't even looked at that chart. There's no way I'm taking that trade. Click no. No, the way I use the TA is I'm waiting for a signal. I see what I'm looking for. I've got a signal or setup that I'm waiting to happen. The signal happens. Maybe I'm not there to catch it. I don't know how many times I've done that where I'm I'm waiting for something specific. And I could still even be at my charts. Like I could be at my computer, but I'm looking at a couple of different currency pairs, come back to it only to realize I missed it by about a minute and it's taken off. It left without me. I'm waiting for that. So I'm going to apply the TA to the chart. And once I apply the TA to that particular chart, it is going to alert me. It'll give me the pop-up. I'm waiting for it. So I'll just click yes. At that point, it'll place my entry, my stop loss, my take profit. It's going to manage the trade for me, but it's one that I had already previously okayed. Like I know what it is I'm looking at. I know that this is the trade I want. I'm waiting for it. It pops up. I'm going to take the trade. Chris, thanks, man. It's 18 after 11 and I am really risking being late. George, I mean, that's perfect the way you say it. If you can't make money trading manually, there's no TA that is going to help you. We can make better judgments than the TA does. When the trade assistant, that's what it is, a trade assistant. It is very aware of the indicators and the formulas and whether the tetragram prints a little green bar or a big green bar, and it will alert you to that. And that is where you step in and say, oh, that's the one I'm looking for. Bang, done. Take it. And then if that's the case, you enter the trade and then it does all the hard work after that. Well, it's not even hard work. It does all the drawn out trade management, sitting at your chart, monitoring the trade work, which is awesome. I love that aspect about it. So that's going to be available to you very soon. This like hours and hours. All right, guys. So I am going to have to end this. Now that we've got this out of the way, I'm going to be quite diligent in the forum about, okay, my trade didn't work. Why not? This is why not. We have this scenario. We know exactly what this is. And a lot of, again, like you said, a lot of it's easier to see in hindsight, but it's a process. It will come. Like you'll start to see this as it happens. The more you practice with it, the more you're familiar with it. And like if you don't know, you don't know. You're going to take a trade. The signal is going to be there. The signal is supposed to somehow know that the market's going to move. That's not the case, but traders don't always know that. All right, the market's going to keep doing what it does until it stops doing it. And then from there, once it starts trending, once it starts moving, once the candles start printing bigger, once the wicks starts, printing smaller, that's what we like. So we want to take advantage of that. All right, guys. Maxinator, I think that's what it's called. The copy guys have these cool names for stuff, and I can't keep up. All right, guys. Thank you so much for this. It is going to be uploaded shortly. I'm going to do my post-production stuff on my end. It's going to take me maybe 15 minutes or so. And then it all gets passed over to Eurosh, and then he does his end. Might take him about an hour or so. Again, this is a process. There's a bunch of people behind this, and it has to go through its channels. So thanks for watching, guys. I appreciate that you were here. And I think everybody's probably very happy that we're calling it a quick one today. All right, guys, we'll see you next week. Next week, support, resistance, trend lines, and what I would consider to be the ultimate trade signal. I love it, and I'll jump over it. Support, resistance, trend lines. There is one thing I'm looking for using those that if I get, I am all over 2-to-1, 3-to-1 ratios for that particular trade. So I am going to make sure that is a big deal next week. It'll keep you out of trades. It'll help you target, adjust your targets. It will help you decide maybe a better stop loss placement, and so on. So it's going to be good. Every trader has to know this support, resistance, trend lines. It's old school stuff, but it's been around forever because it works. All right, guys, you take care. Again, I'm going to end the webinar, and I will see you next week. The cat in the background just picked up. What good timing. See you guys. You take care.